Welcome back. We're picking up a new topic for the day, and that is financial statement analysis, a fairly important topic from CFA Level 1 perspective. Uh, the topic focuses largely on, the three commonly used financial statements: income statement, balance sheet, cash flow, and also talks about certain accounting related, theoretical concepts. So understand and please make a note of it that the program is not about making accountants, right? So the financial statement analysis does not intend to make an accountant. I think the idea is to just give you a brief background around accounting and then focus more on financial statement analysis. Throughout the entire content, which will span over, I think, two more weekends, which means we'll have, I think, minimum four more sessions after today's session. Uh, Throughout the entire session and entire syllabus of financial statement analysis, I think try and understand the curriculum would test you on a lot of numericals and obviously a lot of theory. Although this is financial statements, still there would be theory that is something that we are going to work with, right? So I think theory is equally important, and particularly the differences between US GAAP and IFRS, right? Because the course keeps talking about comparisons between US GAAP as an accounting framework and IFRS as an accounting framework, and keeps highlighting the differences between the two. So throughout the program, wherever you find differences between US GAAP and IFRS, it's a recommendation, make a list, because that list will become your ready reckoner by the time we finish financial statement analysis. And you can, before you hit for your CFA level one examinations, you can just refer to that list, and that could be a really, really useful tool to answer some theoretical questions or differences between US GAAP and IFRS. Perfect. So the book doesn't collect all of them together in one place and presents it. The book has scattered over the differences across all readings that we are going to do, and which is why I think it is good if we can collate all the differences while we study them individually here and there. So I think that is something you should try and look into. Perfect. So we move towards financial statement analysis, and I think important to understand what are the steps in financial statement analysis. And I obviously have to share my screen just. Perfect. So let's get started then on financial statement analysis. The topic provides, as I said, a foundation to understand a company's financial health, profitability, performance trends, etc. I think it is vital. I think it's critical, right? Without financial statements, there is no finance or there is no CFA largely which you will be able to apply. So this is utmost important. You can study it as many times as you want. It is a very high weightage topic from a level one perspective, right? So very, very important from our perspective. Now, what are we going to cover as part of the reading? Steps in the financial statement analysis framework, largely theoretical. Roles of financial statement analysis, again, theory. Importance of regulatory filing, financial statement notes, supplementary information, management commentary, and audit reports. And we'll parallelly look at a financial statement, right? I'll try and get a practical financial statement running parallelly for you as we talk, so that you can also, parallelly look and compare the financial statement. And then obviously information sources that analysts use in financial statement analysis besides annual and interim financial reports. So the first thing, why do we need to analyze financial statement? What is the scope of FSA, or what is the role of financial statement analysis? Primarily, it is used or it is to use the company's financial statement and other relevant information to make sound economic decisions and draw comparison in context with the current environmental situations and similar companies in the industry. In short, you are trying to assess companies' performance. You're trying to assess the performance historically over the last 5 years. How has the company performed? Or you're trying to assess the performance with competitors. So how is my performance vis-a-vis my competitors, right? So I'm trying to analyze financial statement from those objectives or those perspective. Why would I like to do this? Maybe I want to invest in company security, and that is why I want to look at it from an investment perspective. Maybe I want to extend bank credit to the company. I want to give loans to the company. So if I'm looking at as a lender, that's a lender's perspective. Or I am trying to buy the business. I am trying to acquire the company. So I'm looking at it more from an M&A perspective, mergers and acquisition perspective. Or maybe I want to issue a credit rating for the company or the debt issue. So from a credit perspective. And again, there are a lot more economic decisions that can be taken using financial statement. For example, if you are an employee, you want to look at financial statements to understand, is your employer capable enough to make salary payments over the next 3 months? Or is the company running out of cash? If you're a government, you are interested in understanding whether the company will be able to make tax payments. So you analyze it from a tax payment perspective. So the idea is you evaluate a company's ongoing financial position and performance in the past, and then you, using that historical data, project a company's ability to earn profits and future cash flows. And each stakeholder has a different objective. Each stakeholder has a different economic decision to make. Investor looks at it differently, lenders look at it differently, government looks at it differently, and so on and so forth, right? So everyone has a different economic decision to be made by looking at financial statements. Now, what is the framework? It's a 6-step process, and the examination can ask you these 6 steps as part of the question. So they can just shuffle it around, put the sequence in a different order and ask you to identify the right order of sequence. The first step in this is determine objective and context. Why are you doing this analysis? Determine what is your objective of doing a financial statement analysis. Second is gather data. Collect the data for your analysis. Third step, process the data. You cannot use the data in a raw format at times. You may have to process it. You may have to calculate certain ratios. You may have to calculate certain comparative data. So processing the data, and we'll talk about each of these steps in detail. Once you have processed the data, you analyze and interpret the data. And based on your analysis and interpretation, report the conclusions or recommendations. And once again, you can follow up and update the analysis if there is any new information or with the passage of time. You did an analysis last year, and now 1 year is passed, so you want to do an analysis today. So that is primarily updating last year's analysis and following up in terms of how the performance has been, and you try and update it. Now, how is it done? Let's get into step 1. Determine objective and context. As we said, everyone needs to have a clear understanding of objectives to identify data and methodology to be used. Some tasks are well defined and easy, while others might not be. An analyst might be lured to start data punching and calculating ratio without knowing the relevance. So when you get the data, you just don't jump on the data and start doing financial calculations. Understand the data first. Think, is the data relevant, right? For example, you are want to do a financial statement analysis, and I give you the data for gender diversity. How many employees are, male versus female? I've given you the data. The data is of no relevance if you're doing financial statement analysis. right? So the idea is you have to first look at the data, sort out the data in terms of what is useful, what is not useful, and then proceed with your analysis. An analyst should make a list of questions to be answered through analysis. Now, what is the objective? As we said, every stakeholder, we are using the word stakeholder, not shareholder. Every stakeholder has a different objective. Lenders want to do a financial statement analysis to identify credit worthiness, while investors want to do this to for return from the investment. If you are going to invest, I want some returns. Supplier also looks at financial statements from a liquidity position perspective. So supplier is more interested in understanding, are you able to pay expenses? And for supplier, these expenses are sometimes daily expenses because this could be very, very small and marginal suppliers. So they might be looking at daily returns or daily, payments. Then customers also look at your financial statements and their objective is continuity. If I'm going to buy a product from you, will your company survive and will your company give me after sales service? So I'm looking at you more from sustainability of operations. Capital market looks at more from a corporate governance perspective. Government looks at it from a revenue generation ability perspective, and employees from an impact on wages and salaries perspective. So each stakeholder has a different objective to look at the financial statements. And financial statements are a gold mine. There is a lot of information in a financial statement that can help you understand the business better. Now, the second step in this is collect data. How do you collect data? Have a clear understanding of company's business and financial position, which means understand what your company does. As we said in finance, step one for any role that you want to do is understand what the company does. If you cannot understand the company's business, you are not going far in your careers in finance. Along with financial statements, additional information might be required, and top-down approach is followed. That is, start with economy and drill down to company level. So we also tend to do economic analysis and if required, any company analysis, which is not, or which is in connection to the subject company. So once data is collected, we process the data. Now, processing the data involves several tools such as ratios. You can calculate a set of ratios, right? So we have a chapter or reading where we do only ratios. There are around 30 different ratios that we are going to talk about. You can create a common size statement and then you can make some adjustments to financial statement for like to like comparison, right? So when we say like to like comparison, the idea is if, you know, some other company has, second and fourth Friday holiday for them, the way if you're going to compare them, your comparison should be like to like, right? So if, for example, there is a company which only operates for 2 Saturdays, which means they will have, out of 4 Saturdays, they will have only 2 Saturdays working. And in that case, their financial statement will have more number of days, right? They are operating business for more number of days versus another company which has 4 Saturdays holidays. So their 2 days of operation is lesser. You cannot compare the sales then because one company is selling 2 more days, other company is selling 2 less days. It's as simple as it gets. Comparison will require some adjustments to statements for like to like comparison. Then analyze and interpret data. Once you have processed the data along with quantitative results, analysts should provide interpretation and qualitative comments. So the conclusion or the recommendation is important, right? So once you analyze, you have to present your analysis, right? And interpret what the data is, and then report conclusions or recommendations through, valuation, estimate risk, historical data, all through a report, right? In generally, we present a report. We generally do not give our financial models, because financial models are something which is an intellectual property for us. So we generally provide a report as part of the financial statement analysis framework. And then periodic review is required and might involve going through the previous steps. If the client needs a report update, which means let's say the client did last year and the client also needs this year, then we go to the client and ask if there are any changes to, qualitative factors like risk or estimates or historical data, etc. And then follow up and update the analysis. A periodic review is required and might involve going through all previous steps. So it's basically an update. You want to do a quarterly update, you want to do a semi-annual update or annual update. It depends on the management, right? What type of analysis you would like to update when, right? But in general, yes, every time if you're tracking the stock, you have to issue a updated report. Now, scope of financial statement analysis, it is the way companies show their performance information to the public, right? So financial reporting is a way of exhibiting your performance, how good or how bad the business has been over the past quarter or over the past years. While profitability is important parameter, cash flows are more critical right now. Understand, profitability is good, but what if you don't receive any cash? In that case, you're saying my company is profitable, but I have no cash because I did $1 billion of sales, right? You did sales worth $1 billion, but cash received is zero, which means the customer took all this on credit, right? So the customer did not pay even 1 rupee for the transaction. Customer said, I'm going to pay after 30 days. So till 30 days, your cash is zero. You may show profits or sales of $1 billion. You may say that, after subtracting expenses, my profit after tax is $500 million. But the problem is, till your car doesn't come here, it looks as a plug, or it looks as a loophole that, okay, you just have $500 million of profit after tax, but reality cash is zero. Customer didn't pay you anything. So we have to understand such a element while analyzing financial statements, because companies need to pay cash to employees and suppliers, and this will provide flexibility in funding capex for business opportunities. It also helps in serving debt to pay interest and equity to pay dividends. And in terms of liquidity and solvency ratios, the ability to meet short-term and long-term obligations, it constrains it for me. It just constrains this ability. And that is what we are talking about. If you talk to a company which has which needs money in the short term, they will say that, okay, the the government is taking such a high down payment on the loan. There is no money left for, working capital, and therefore I want to now borrow short term because all money has been used to do the M&A or mergers and acquisition. So key thing, it is there to show their performance information to the public, but the criteria here is not satisfactory, right? So to understand, we cannot have only, let's say, I will do only suppliers or only employees. You have to do exhaustive. So this is not an exhaustive list. Let's put it this way. This is just an indicative list for us to start doing analysis. Now, sources of information. When we say sources of information, there are various sources to collect information, in which financial statements in regular interval are the most common. Then, along with statements come financial notes and supplementary schedules. Companies provide you this financial notes and supplementary schedules. Then there is a management discussion analysis section. Then external auditor report and any data from other sources. So let me quickly open a US balance sheet. I have to check, is my internet working? Uh, give me 1 minute. I'll get the document for you. All right, perfect. So let's load a document and I can share my screen to show you how a financial statement will look like. So now, please remember for US market, right? All the financial statements that you're going to look at from a US market perspective will largely be available to you on a website called SEC, Securities Exchange Commission website, and the website is goes by the name of EDGAR, EDGAR. So you can go to Securities and Exchange Commission for US, and in this you can search for companies and their financial statement. So I think you should always have a financial statement ready when you're reading this topic. For example, I will search for a company called, let's say, Microsoft. Let's just search Microsoft. So I'll get Microsoft Corporation here. I'll click this. And in this, you will find there are a lot of forms, right? So you will notice there are a lot of filings, right? Filings 4, filing S8, 10Q. So 10Q is their quarterly filing. 10Q is US quarterly filing. So we can look at 10Q for now. So I will open a 10Q for you. Okay, perfect. Let's just move this to an HTML format that would be easy to work with. Perfect. So this is how a annual statement or a quarterly statement will look like. This is a quarterly statement, form 10Q. 10Q is a quarterly statement, and if it is 10K, K is an annual statement for US companies. Now, in this, if you will see, there are obviously financial statements. After financial statements, you will notice there is a management discussion analysis section. There are notes to financial statements, which is here. And then there is obviously auditor report, other sources, other information is here, risk factors are here. So all this information is something that is very useful for us. These are all source of information, right? So when we say that what are the sources of information, we have financial statements which are published regular intervals. So US companies publish 10Q 3 times for 3 quarters. And then the final quarter, they publish 10K, which is their annual statement. This is their quarterly statement. And then whenever there is some important event, US companies publish 8K, Form 8K. 8K is for important events, right? So like this, there are many forms. S1. S1 form is when US companies are going for IPO, right? So they publish an S1. So you will get financial statements, you will get financial notes, a section on management discussion analysis, auditor report, and other sources. Now, all of this in terms of issuer sources, you will get earning guidance, ad hoc presentations, and events and press releases. There are public third-party sources which are free. Free industry reports, government agencies, industry data, social media. This is all free data. But then there is some paid database, proprietary third-party sources or database. For example, Bloomberg as a database, FactSet as a database. There is Capital IQ as a database from S&P. So some of these databases are important, and these databases can also offer you information. And then there is some proprietary primary research, studies, hands-on experiences, and data advice of technical specialists. Right. So you have ample information to analyze, and you've analyzed this information to answer or figure out what are the good and the bad points or parameters for the business. Now, what are these other sources of information that we are talking about? We have proxy statements. Proxy statement means forms to be used for voting in the absence of shareholder from the AGM. And this will highlight decisions that need shareholder approval, such as appointment of director or auditor, any merger and acquisition. Right. So if a shareholder cannot come and attend the annual general meeting, AGM is annual general meeting, right? If you cannot go and attend an AGM, then you can vote in the absence of the shareholder by filling up a proxy statement. Then interim reports. As I said, company issues semi-annual or quarterly reports. In US, you present 4 financial statements and condensed notes. So 3 quarterly and 1 annual. These statements are not audited. So these statements are not audited and provide updated information since the last annual filings. So these reports are again very, very useful reports. You may get, apart from these 3 quarterly and 1 annual statement, in between also you can get interim reports. Then there is press release and conference call data, trade journals and other external sources, and statistical reporting websites. So data, especially in Western economies, is in abundance. And you will have to figure out what is useful and what is not useful, what should I include and what should I exclude, given the time on hand for any project. Now, before we get into each financial statement, let's talk about what are the frameworks. So we are generally focused on 2 accounting standards, US GAAP and IFRS. US GAAP is United States Generally Accepted Accounting Principles, right? So GAAP is Generally Accepted Accounting Principles. Accepted accounting principles or policies. And IFRS is International Financial Reporting Standard, which means this is something which is actively followed in US, and everyone is trying to follow IFRS now. Even for example, India as a geography is trying to adapt to IFRS. Other countries are also trying to look into IFRS. What IFRS does, IFRS says it will be the same rule across all geography. So that when I am comparing one company from India to one company in Singapore to another company sitting in US, I don't have to worry about because all financial statements follow same set of rules and regulations. So IFRS is trying to bring everyone together. However, the traditional accounting US GAAP still exists and is still pretty widespread. So that is your global accounting standards, and the two standards on which we are focused or our exam is focused on. Security regulators, IOSCO. Again, this is the International Organization for Securities. US Securities and Exchange Commission. Again, that is one authority where you would like to be very, very careful because any SEC, related issues can can go at a very large scale, right? So US SEC is equivalent to what we see in India called SEBI, right? SEBI or Securities Exchange Board of India is an entity which takes care of all capital market related rules and regulations. So SEC's role is also very similar, uh, you know, to take care of the US securities and exchange or securities exchange largely. Similarly, there is European Commission, European Securities Commission, ESC, and European Securities and Market Authority. So remember, if you have to collect data, SEC is your best bet to collect data. Now, let's get into the core of financial statement. The core of financial statement is looking at each of these statements. And remember, they have been awarded, of these statements, each has been awarded one separate reading in our syllabus, right? So they are very, very exhaustive readings for all the three. In particular, income statement is very, very detailed. So let's get moving on financial statements now. Once we understand what is the purpose, for whom are we doing it, what is their purpose, like if this is an employee, he is interested in balance sheet cash. If it is government, they are interested in tax payments, as I said. So let's talk about these statements in detail. Now, there are different formats which have been prescribed by law under accountancy. So the balance sheet format keeps changes. In early times, the balance sheet was a T format, right? And you had assets and liabilities written on either side of the balance sheet. And now we have more of vertical balance sheet like this. So we write current assets, current liabilities, total liabilities, and we effectively add them to get to the total of the property. So income statement, balance sheets could have different formats. That is the point. I think different formats have been prescribed by law or accountancy. Each format communicates a separate aspect of the business. And these are released on a regular basis, like quarterly, half yearly, or annually. Now, what are the different financial statements? Income statement to start off with. Let me draw a plain vanilla income statement for you first. Let's just open the touchpad. Where is the presentation gone? Here is the presentation, and here is a small notepad for you. Okay. So how would the income statement look like? An income statement will always start from what is called as revenue, or this is also referred to as sales. Oh, this is going to convert. This is getting smarter day by day. That is why I love my Excel sheet. There's not enough space here to write, otherwise I would have written it. Oh, let's give Excel 1 minute. There we go. Okay, so how would a simple profit and loss statement look like, right? Before we get into details of profit and loss. So a simple profit and loss statement will start with revenue, which is also called as sales. And from revenue or sales, we are going to subtract what is called as cost of goods sold. What is the cost of goods which you have sold? From this, we are going to get gross profit. And from gross profit, we are going to subtract all operating expenses. All expenses. What you will get is EBITDA, EBITDA. Some of you would have read it, earnings before interest, tax, depreciation, and amortization. Okay. So EBITDA is nothing but a type of profit. Let's put it that way. It's a type of profit, just called a different word. From EBITDA, we subtract what is called as depreciation and amortization. What you get is EBIT. From this, you subtract interest expense. And what you get is EBT. And from EBT, you subtract tax. And you get what is called as profit after tax. So this is how our income statement looks. And now once you will read the text, you will understand it shows revenues. Along with revenues, it shows expenses like this. These are all expenses. And net income to reveal if operations generate profit. So the idea is whenever you are reading an income statement, it measures profitability, shows revenues, expenses, and net income to reveal if operations will generate profit. These statements are also basis for financial ratios. They form the basis for profit margins, EPS, and other key metrics. Then guides forecasting and budgeting. The past data which income statement uses also helps you forecast revenue, cost, and cash flows. Compliance and transparency provides standardized, reliable reports for regulators and analysts. So the role of an income statement is to present what income did you earn, from where, and any departures in terms of what you have disclosed versus what you have as income, right? You cannot disclose very low income and have a very high income. That will attract scrutiny or put the individual behind the bars. Now, when we look at balance sheet, also known as statement of financial positions, prepared on a particular date, example ending 31st March 2025, discloses what is owned and what is owed. So assets and liabilities are disclosed by the you know by the company. So assets and liabilities are typically part of balance sheet equation. Let's look at the balance sheet for Microsoft and income statement for Microsoft. So let's first go to income statement. So if you see, this is how income statement looks like. Microsoft had a 25,000 or 2060, yeah, 16.45 million rupees of profits. That is roughly $16.5 billion of sales of product. And then there was also service sales. Then once you have the product, total product ready, cost of revenue is zero. So there is no cost of revenue, but only cost of revenue for products may be there, right? For example, if you're developing products or if you're providing services, you may have, some servers on which you're spending some electricity, etc. So those are your cost of, generating revenue. And then if you see in this, there are operating expenses, research and development, sales and marketing, general and administrative. These are all operating expenses, right? So these are something which are important. And after that, you have operating income, which is EBIT. And from this, we get to income taxes, liabilities, and cash flow from operation or the net income statement, right? So income statement effectively will look exactly the same. It will tell you there are revenues, cost of revenue, and after that, three categories where expenses are generally looked into. So an income statement looks very similar, and a balance sheet also has only these elements. A balance sheet has assets and liabilities. So if you notice, both of the balance sheets should tally to each other, right? The idea is both your assets and your liabilities should match in terms of numbers. That is the first parameter for balance sheet. All your assets should match all the liabilities and equities which are here, right? So if this is 665,302, we have to manage 665,302 on the equity side. Okay, no questions there?
Yeah, everything is clear.
Perfect, sir. We'll move. So where is my presentation? Here it is. Perfect. And again, remember we have detailed readings for each of these components. So we are just going through an overview and then we'll take individual topic wise readings. The third statement, which is now getting published, earlier it was not part of the financial statements, is statement of comprehensive income, right? Earlier there was only income statement, balance sheet, cash flow. But now we have a fourth statement which gets published, which is called as statement of comprehensive income. First, what is the equation? The equation is comprehensive income. If you want to calculate comprehensive income, you will have to take net income. And to this net income, you will have to add, other income. Right? This could be income from, from any other sources which are not related to the business. So net income and other comprehensive income, right? Let's call it other comprehensive income. And these are different. This is other comprehensive income. This is comprehensive income. They're different words, right? Now, what it includes in net income, we give profit and loss from core business. But in other comprehensive income, there are four things. One, two, three, and there is one more thing. So unrealized gains and losses on investments, currency translation adjustments, gains and losses on pension funds or hedging instruments, and fourth is derivatives. So these four things are not included in other, or these are the only four things which are included in other comprehensive income. And when you add net income and other comprehensive income, what you get is a comprehensive income. So if you look at our Microsoft's financial statement, you will notice there is a comprehensive income statement which starts with net income. Right? This typically starts with net income, and from net income it adds net change in derivatives, net change in investments, translation adjustments, three, four items. And this is where we close what is a comprehensive income statement. I think most important, remember the equation. A comprehensive income statement is net income plus other comprehensive income. And other comprehensive income has four transactions. They ask you this in theory also, right? So this, and this, these are the only four elements which get recorded in other comprehensive income. So both the equation and the four components of OCI. Then there's statement of change in equity.
Sir, sorry, just one
Yep,
small question.
sure.
So what for this the previous component, right? So what's actually the difference between that and the income statement? It's a bit confusing.
So in other, so there are certain elements which are recorded in the income statement. So they flow from the income statement to the balance sheet. But if something does not get recorded in the income statement and it straight away has to be recorded on the balance sheet, then it will go through your other comprehensive income. So there are certain things in accounting, like the four transactions where we said they do not impact your income statement. They do not hit your income statement. And because they don't hit your income statement, they are directly recorded in shareholder equity section, right? So in short, if I have to explain it in such a way, OCI represents those four transactions which will directly be reported in your equity section of the balance sheet. They do not go to the income statement, and from income statement, they don't come to the balance sheet. So let us go back to our income statement here. Okay, perfect. See, what is the link? This is my income statement. Okay, this is the income statement that I've made, and I have a balance sheet. And on the balance sheet, I have assets. On the balance sheet, I have liabilities. And on the balance sheet, I have a section called equity. Right? So assets should always be equal to liability plus equity on the balance sheet. Now, anything which is not getting recorded here, right, but has to be recorded on the balance sheet in the equity section is OCI. Let's first take an example of what gets recorded. So you can tell that, okay, I have 100 rupees of sales, 10 rupees of cost of goods sold, 90 rupees of gross profit. Then I have another 15 rupees of operating expense, which means 75 rupees of EBITDA, 5 rupees of depreciation, 70 rupees of EBIT, 10 rupees of interest, 60, 30 rupees of tax, 30. So my profit after tax is 30. Now from this 30, you pay dividends. Let's say you have paid your shareholder 8 rupees of dividend. What is left is 24. and this is typically known as retained earnings because you don't have to pay anyone now. So this 24 gets recorded here in the equity side of the balance sheet. And this is typically, as I called as retained earnings. So what happened? If you say I have one more expense of 5 rupees, that 5 rupee expense went through the profit and loss, and from the profit and loss, it went to the balance sheet. But then the 4 transactions that we talked about, they don't come from the profit and loss. OCI will always represent, incomes or gains or losses that are not part of normal operations. And therefore, they are not part of income statement where they directly come here. OCI directly gets recorded in your equity side of the balance sheet. So it does not hit or impact your profit and loss statement. So I think that is the difference, and which is why we have a statement which helps you reconcile that what is changing, right? So they are saying that, okay, your net income was 38,458, but then there were certain adjustments, other comprehensive income, and this other comprehensive income reduced or increased your comprehensive income. So the term which includes comprehensive or other comprehensive income in it is called as the other comprehensive income will include all these 4 transactions. Now, what is statement of change in owner's equity? I'll also show you that statement quickly. So balance sheet, cash flow statement, statement of change in owner's equity. Now, if you see, this is telling you that what are the components of equity, right? So first, let's look at balance sheet. On the balance sheet, you will notice these are the components of equity. There is a common stock, there is retained earnings, and there is accumulated other comprehensive loss. Right, so these are the 3 elements of equity side of the balance sheet. And for each element, we have a footnote here. So just for each element, where is the change in owner's equity? Yeah, see, for common stock, what is this telling you? This is telling you that, okay, common stock was 110. Then we issued some shares. Then we purchased some shares. We also give some bonus. So my total beginning end of the period is 112,788. So you are able to reconcile from 110 to 112 how the change has moved. You can do the same thing for retained earnings. I started the year with 2 lakh or 254,000. Then I added this year 38,000 of profit. Then 6,700 was paid as dividend and 5,785 was common stock repurchased. So you're looking at the closing figure 280,789. The idea is all these statements help us reconcile. They help us understand why did the change happen, right? So in statement of change in owner's equity also, owner's equity will include capital, retained earnings, and anything else if required. Retained earning is the cumulative profit held by the company on behalf of shareholders. So retained earnings are profits from the day of inception, total cumulative profits from the day you start business, right? So every year it says retained earnings during the year is net income minus dividend, right? And that is what we were doing. We said in our Excel sheet that from net income or profit after tax, if you pay dividends, whatever is left is retained earnings, right? So that is exactly what the slide is also trying to say, that retained earnings during the year is net income minus dividends. If you don't pay dividends, no problems. You will have full net profit as your retained earnings. Formula for retained earnings. You will start with beginning value. You will say last year my cumulative profit was 100. This year I am adding net income, my net profit or profit after tax of 30 rupees. And from this, I am subtracting dividends. So if I paid 10 rupees of dividends, then 10 rupees gone out of my pocket. My closing value 130 minus 10, 120. So this is how the equation for retained earning works. It's beginning value plus net income minus dividend is closing value of retained earnings. Now in changes in equity, you can also see non-controlling or minority interest. What is a non-controlling or a minority interest? As the word suggests, a non-controlling or minority interest is someone owning a very small part of your business externally. So let's say I own 2% shares in the business. Then I am a non-controlling or minority investor in the business. Right? So that is also a component of owner's equity. And the final statement is cash flow statement, right? So the final statement is cash flow statement. A cash flow statement, as the word suggests, talks about cash. How much cash do you have in the business? It includes three activities, mainly operating, investing, and financing. And that is how you will see the profit and loss statement also looks like. Okay. So if you will see, this is a cash flow statement. And there is one which is operations, there is other which is financing, and the third which is investing. And we add all three. And based on these three cash flows getting added, we calculate net cash. And that net cash is added to your opening cash balance to close the year on what is the ending figure for cash balance. Now, the idea is whenever you're doing a cash flow statement, what are these three activities talking about? These three activities are for different purposes. Operating activity talks about the core operations of the business, right? Day-to-day activities which are necessary for the business functionality. Whereas, sorry, investing activity talks about or includes transactions which are related to acquisition and disposal of assets. Buying, selling of assets is all about investing activity. That is a business investing activity. Financing activity relates to obtaining and repaying long-term liability. For example, issuing common shares, issuance or repayment of debt. So those are typically financing activity. Now you can prepare the cash flow from or cash flow statement, and specifically, let's say the cash flow from operating activity using direct or indirect method. Both of them are covered in level 1. IFRS provides flexibility than US GAAP in terms of classifying payments or receipts of dividend or interest. Right. So the IFRS has small differences. As I always say, IFRS will have minor differences from US GAAP. And that is where you will have to make a list Note down the differences between IFRS and US GAAP, and every time when there's a difference, add it to the list. And keep reading the list. It may get boring, but I think keep reading financial statement analysis theory once again, right? As I said, the paper will have 65% theoretical information to be tested, only 35% of math to be tested. Now, financial notes and supplementary schedule. So there is also a possibility that you require an integral part to substantiate four financial statements. These are basically additional information. This is additional information which has been provided to you as part of financial notes and supplementary schedule. Information about estimates, assumptions, accounting methods. So, a lot of times, what does the company provide you as an information? The company tells you how much of my revenue comes from US as a geography versus Europe as a geography versus Asia as a geography. So it's an important information, but that type of information may be provided. Geographical breakup of revenue. Then at times the company also provides information around key product. Like, what is the key product of my company, and how are we doing on the key product? Any new launches, etc., you may get as part of financial statements or supplementary schedules. This is supporting information. This is additional English which supports the numbers. Then additional data on business segment, related party transactions, M&A, or significant customers, right? So all of this information is provided. In a way, think about it from a financial note perspective. They would like to understand how safe the business is. And finally, allow users to improve their assessment of timing, amount, and uncertainty of estimates. So notes and supplementary schedules are very, very important from the perspective of analysis, right? You should not simply be fixated on anything else while reading notes and supplementary schedules. I think very critical from an examination perspective. Information about estimates, assumptions, and accounting methods used for financial statements is also presented in these notes. These are like running commentary. If you're reading something and if you need some information, you can go to the notes, and the notes will help you either retrieve the information from the physical libraries, or you may have an AI agent which can do this online for you. Additional data on business segment, related party transactions, M&A, significant customers, as we said. Now, what type of information can you see? So let me just walk you through a sample note. Right. So see, these are notes to financial statements. What you see on the screen is notes to financial statements. And they explain, note number one explains accounting policies. How do they do their accounting? Note number two explains earnings per share. Right? Last time when we were doing these calculations, we said you can do an EPS calculation. Then other income and expense. Right? Notes will also tell you investments, where has the company invested the amount of money. So notes are extremely critical. It offers you a lot of information about the business. Then comes management discussion and analysis section, a very, very, very important section. A management discussion and analysis section is arguably one of the most important component of annual report. It provides assessment of the financial performance of the firm from management's perspective, and there is no requirement to get this audited, so generally unaudited. that is a big relief for a lot of companies, because it's an unnecessary document for a lot of companies to get this audited, right? So no requirement to get this audited. They are generally unaudited. In the US, public companies are required to disclose the following information in MDA: the result from operations with trends in sales and expense. So this is mandatory. This is something that you will have to disclose. General business overview, capital resource and liquidity, along with trends in cash flow, and discussion on significant events. So mandatory. You have to at least provide me these four inputs if you're going to talk about management discussion and analysis section. Apart from this, everything else is optional. So this is, I think, an important information. This is not compulsory to be required to disclose under MD&A section. Let's just go to an MD&A section on our report. Right, so let me just find that section for you, management discussion. Let's just go to the top of our document. Management discussion and analysis. Perfect. So take a look at this. Read, I think, only the initial few lines, and that should help you understand what the management discussions and analysis talks about. I'll give you a couple of minutes to read. Just read, scan it. I think when I say read, I think just scan and try and understand. Just read. I'll give you 5 minutes to read this. I think in particular, you should read this, right? Highlights from fiscal quarter or the second quarter, right? This is something that the company is telling, okay, what does Microsoft do? Where do we generate our revenue from? And what were the highlights from the prior quarter? And then if you see there is industry trends and opportunities, there is economic conditions, seasonality in the business. All of this is information which is very important from a Microsoft perspective. So MDA section is providing you summary result of operations. So it's a very critical section. And mostly when you read annual reports, we cannot finish annual reports without MDA and a section. So just give a quick read to these lines. I think this should be good enough for you to leave with what an MDA does. Perfect. So this is just a preview in terms of what these sections are all about, because we are reading about the section, so we should at least be aware about how the section looks. And you can download any listed companies, 10K or 10Q statement from SEC website, as I said, and just browse through them. And these are very long documents, right? Today, the purpose is not to read them, word by word or page by page, but at least have a visual idea in terms of what the information it carries. And it's easy for you to respond to some questions once you have a hands-on experience on how the data looks like. So if you find time, and if you like to follow some company, you're a very, a fan of the company, or you love the business, for example, Apple or Tesla, I think just download the business annual report and read, scan it, as I said. Now, these
So
statements,
is
yep,
the MDA from prepared by the management itself?
yes, a lot of it comes from management, because therefore we say it's management discussion and analysis section. And if you will see, it's a lot of this information is from management's perspective.
So in that case, it could be a bit one-sided, right?
That's exactly what is our role here. So once management provides us information, we have to. It's our choice. Do you want to take it on face value, or do you think there is biasness in the data? Right. So that is exactly where we have to look at the data, and then perhaps take a decision. How confident are you using the data provided by the management? Absolutely. And management biases do exist in data.
Yeah, let me just give you, according to what I've been seeing last time, there is a new, let's say, new standard from IFRS 18 that will be applied next year. That will be like a compulsory in order to like reconcile this part with all financial statements. So I think we'll minimize all these, let's say, big issues.
Yes, the problem is acceptability, right? So I work with a lot of US clients, Canadian clients, Indian clients. The problem is IFRS is trying to merge all of it. However, the larger issue is a lot of businesses or a lot of countries are trying to find a path between IFRS and their local standards. And the reason I personally believe is vested interest of certain companies, certain groups, because in a way, some changes to accounting does impact your financial statements, profitability, key ratios that you present, right? So you will have mandatory subtotals when you will have IFRS 18 coming up. I think they said they'll have operating profits and profit before financing and taxes will be presented separately. Even in management, parameters, companies at times report non-GAAP numbers, right? In IFRS 18 will now they will have to disclose if there's anything non-GAAP, like an adjusted EBITDA is a non-GAAP metric. So it would keep happening. I think it will keep changing over a period of time. Companies have their own objective. Auditors, I don't know how clean the auditors are also in this case. We do teach auditors. As an engineer, this is very, very new to me when I read all of these things. I come from an engineering background, and when I see an external auditor report, I always believed auditors do a great job. But over the last 15 years, I've realized it's not specific to Asia, it's not specific to Europe, it's not specific to United States. There have been problems with auditors across the globe, right? There are companies which have just, just got it signed from the auditor, and I don't know how. So from our perspective, whenever we read all this information, CFA Institute is telling us, okay, this is the information. How do you assess it? How do you analyze it? Is qualitative. And that is where exactly an analyst comes into picture. A lot of people ask me, is AI going to kill a lot of the analysis that we do? AI is going to make it easy. However, end of the day, you will still have to sit through it, read it through it, and try and make links in terms of, why a specific element is looking like this. So there's a gray area, agree on accounting, and specifically as an engineer, I always believe there's a gray area across accounting. We assume everyone is ethical when they prepare these statements, but again, we have seen frauds and scams happening, right? So for now, we'll live with the thesis that okay, everything is done in the realm of being, you know, right, and that is something that we are trying to assess. And in that same linkage is what you see next on your screen is an external auditor report, right? The so-called accounting expert appointed to independently, verify, review the financial statements prepared by management. Now, the point is the auditor is also appointed by the management, right? The board of directors and the management, along with shareholder approval, gets an auditor. And remember, it's a conflict of interest business. If you're auditing, obviously you are getting a signing fee. For that attestation function, signing and certification, uh, you may want to sign even if you think there are some flaws, if the fees is handsome, because this is a very competitive market, and if you don't sign the statement, some other auditor will sign it. So there are some auditors who may want to take risk. And I'm not talking about small auditors, even large auditors. We have seen issues with large big four audit companies. And even big four auditors have signed statements which are controversial still, right? So I was reading about a company called Wirecard, if I remember correctly, Wirecard from Germany, right? And one fine day, Wirecard, and if I remember the name right, Wirecard said we are not able to find 2 billion euros, right? Think about it. You are saying you're not able to find 2 billion euros, and the auditor, a renowned auditor in such a case, it's very, very difficult to understand how are you not able to find 2 billion euros of cash, which is non-existent. And that is as simple as it gets in terms of audit. If as an engineer, I understand this. If I have to audit cash, I think the easiest way to audit cash is go to the bank, get a statement signed and stamped from the bank that there is 2 billion euro sitting in the bank. Then how could a big four audit firm miss it out? Right. So that is typically where we say the companies or the audit companies are not per se bad or at a, or that is their problem. The point is the company is still run by individuals, and one or two individuals here and there may have a motive or an opportunity for doing an illicit information or illicit signature on such things, and that can cause issues. But yes, a Wirecard is a study, is a case study in itself, and a big four audit firm. How could this slip under their nose is very, very difficult to comprehend at times. But all said and done, we assume auditors do great job, and the objective of their audit is to get an independent opinion on reliability and fairness of the statements. They should check generally accepted accounting policies or principles were followed, examine efficiency of accounting and internal control systems, and internal control systems under the Sarbanes-Oxley Act, right after the 2008-9 crisis, and specifically after the Enron case before that, US introduced what is called as a Sarbanes-Oxley Act of 2002, more commonly known as SOX Act. So Sarbanes-Oxley Act was more or less responsible for internal control systems after Enron, went bankrupt, and it took its auditor Arthur Anderson also bankrupt with itself. Their key role is to determine if the financial statements contain any material errors or not, and they address their report to the shareholders, right? So auditors have a fiduciary responsibility towards shareholders and not towards the management who has hired them. They are generally answerable to the shareholders. Different accounting frauds, as we have said, have led to the debate on the role and responsibility of the auditors, or are they actually doing their job correctly or not. Now, auditors typically provide four types of opinions. An auditor can tell you that a company and issue an opinion called as unqualified opinion. What does an unqualified opinion means? The auditor is trying to tell you the financial statements are free from errors and material omissions, and they represent true and fair picture of the business, which means if your company gets an unqualified opinion, that is the best. You're doing great as a business. You're not hiding any information. No, no misrepresentation of data has been done. Everything has been presented fairly. So unqualified opinion is the best opinion. Qualified means there are a few material issues. Financial statements reflect true and fair picture of the business. The above material issues do not change the overall message communicated by the statement. And auditors must explain these exceptions in the report. So there are minor material issues, but these issues in a way do not change the overall thesis of the report. You can still trust the report and you can still take a decision. Qualified opinion is slightly problematic, right? Let's say there are a few things which can be corrected and made it better, but you can still live with a qualified opinion. Let's put it that way. Adverse means the statements do not represent the true and fair picture, and there are material omissions and errors, which means the statements are not reliable at all. These statements are junk. You can ignore the statements and take a decision if you want. The statements are of no use. Adverse opinion is a bad scenario for a business. And if an auditor is unable to give you unqualified, qualified, or adverse, the auditor is going to give you a disclaimer of opinion. A disclaimer will say, due to some circumstances, an auditor is unable to express any opinion. Maybe lack of information. The auditor did not get enough information. So the auditor can't say qualified, unqualified, or adverse. And in this case, the auditor puts a disclaimer. But please note, the disclaimer does not mean that the financial statements are incorrect. It is just saying we are unable to offer any opinion. It's an inability of expression. And this may be due to lack of data or lack of expert help provided to the auditors. So the auditor can issue any of the four opinions as part of auditor's report. Footnotes or notes to accounts, as we said, additional information presented, segment reporting, acquisitions, anything over and above what your financial statement does will be presented in your footnotes. So step one, you should know how an annual report looks like and what are the type of information or data such reports carry for us. Because these reports effectively provide us a lot of information to analyze. This is not only merely numbers. There's a lot of English here. And all of that is something that we would like to focus and read from our perspective or from our objective. Questions on the first part of the topic, right? Generic part, but yes, almost mid of the session. And then I think we'll start income statement post a short break. All good?
Yeah. Yeah.
Okay, perfect. Good then. We are almost mid of our session. Usual break, 15 odd minutes, and then I think we will pick up on income statement. I'll catch some breath by then. We'll pick it up at I think 15 minutes from now. I think good enough to get started again. Right. So we'll resume in another 15 minutes. Take a break. Okay, perfect. I think let's just get started with the income statement. Now, when we say income statement, I think let's get clear in terms of terminology. Basic terminology is fairly simple. You call it revenue or turnover or sales or net sales, or you can also call it, some people call it top line, right? It's all the same, right? So revenue or sales is what you generate by selling products or services. However, within revenue or sales, you could also hear words such as gross sales and net sales. Classical example, when Amazon sells an Apple phone or an Apple handset or a mobile, Apple, you may sell it for, let's say, $1,000. Okay, that is gross for Amazon, right? Amazon's gross sale is $1,000. But after paying for the product, which is the cost of goods sold, let's say $995 for Apple, the $5 that you get is your net sales. Right? This is exactly like airline tickets. You can use a portal to book airline ticket, right? You can use any portal. You can use, let's say, a Sky Scanner. And on a Sky Scanner, you book an airline ticket. The airline ticket is costing me, let's say, another $500. My point is the entire $500 is not the sales for Skyscanner. That's the gross sales. From this, obviously, there could be returns and discounts. Like in tickets, there may be discount available. So you will subtract those discounts to get to net sale numbers, right? So always, whenever sales data is provided to you, ask and get a clarity. Are we talking about gross sales or net sales? Then there are also obviously returns. Product is returned, that needs to be adjusted. Sales recognized in the period in which they are earned, not necessarily when the customer pays, right? And this is, I think, very important as a line. This is a line which fits Netflix perfectly. So when I buy a Netflix subscription, I pay upfront, right? I'm paying upfront for an annual subscription. Now, when I pay upfront for an annual subscription, that does not mean that is the sales for Netflix. Please remember, the customer has paid, but the services have not been provided, which means you have not earned the revenue. The amount of money that Netflix receives is recorded on the balance sheet and it is called as deferred revenue. Deferred revenue means the revenue is yet to be earned. It is not yet earned. It is just the revenue has been booked as a liability for now. 1 month, Netflix provides me service. They will do a pro rata mathematics and record 1 month revenue and reduce your liability by that amount. So when you pay upfront, for my balance sheet, I call it prepaid expense. On my balance sheet, this is a prepaid expense. I have prepaid the amount to Netflix. For Netflix balance sheet, it is a deferred revenue, which is a liability. For me, it is an asset. But it is not revenue today because the customer has paid, but we work on accrual concept in accounting. We don't work on cash accounting. We work on accrual accounting, which means either the revenue has to be earned, then only you can record it as a revenue and not before. So revenue is only recognized if it is highly probable that it will not be reversed. So until and unless you have a time period to return the product, you should not record it as revenue. Only once the return time frame is completed, you can record it as revenue. Now in this, as I said, comes terms such as unearned revenue. Unearned revenue is nothing but what I just explained to you, also called as deferred revenue. So all companies which sell subscriptions, all software as a service companies, SaaS companies which sell subscription, have deferred revenue or unearned revenue on their balance sheet. in which they say we have not yet rendered the services, but the payment has been received. So we will call it unearned revenue and classify it as a liability on our balance sheet. Advance received from customer before the delivery date. The entry for this on the other side is prepaid expense, an asset. Services not taken by me, but payment has been made. I've made payments to Netflix. I've yet not taken the services. My services will start now. So the rent or payment has been made in advance for 1 year, 2 year, and so on and so forth. So it is a prepaid expense. And then there is accrued expense. Services taken but no payment made, like salaries. Salaries is a classical example of accrued expense. I have worked for the entire month. I have given my services to the company. The company has not yet made payments to me, and therefore salaries act as an accrued expense. Payroll related taxes, right? Payroll taxes are all accrued expense, where services are taken but no payment has been made. And then accrued revenue, where services have been rendered but payment is due. Sales have been made but payment not received, right? So these are the four terms which are related to each other, right? Always remember these are the four terms which are related to each other, and we generally have to record them, right? So everyone who is going to create accounting statements has to find a way to record them on the on the appropriate end. And remember, this gradually gets reversed also. Like for example, if you keep giving me services, your deferred revenue will start reducing, your liability will start reducing, and that will become what is called as your revenue now. So it gets amortized. Let's put it that way. Right? It gets amortized over a period of time. So from our perspective, these are the additional terms which we should be aware about. Now, the point is, in accrued revenue, the services have been rendered, right? Which means revenue has been earned. If you have serviced, your revenue has been earned. But the key difference between accrued revenue and another term called accounts receivable. You might have heard about the term called accounts receivable, right? In this also, you have given the services, right? So in both the cases, services are rendered, given services or services rendered. Then what is the difference? In accrued revenue, you have not billed the customer. You have not yet billed the customer. Okay. So for example, I offer a training, and after my training, I provided my training for 3 hours. Now, until and unless I don't bill the institute, it's an accrued revenue where revenue has been earned. I have provided 3 hours of service, but I have not yet billed or invoiced the customer. So that is an accrued revenue. As soon as I invoice the customer, then it is account receivable, because now I have already raised an invoice, right? So the customer has been billed. And if the customer has been billed, that becomes a receivable. The invoice has been issued, but payment has not yet received. So there is a small difference between accrued revenue and accounts receivable for us to remember. Now, for IFRS and US GAAP, how do you recognize whether there is a revenue which should be recognized or not? So we are talking about a concept called as revenue recognition, right? Should I recognize it as revenue or not? Revenue recognition. Companies should recognize revenue to depict the transfer of goods or services to customers. And this is in amounts that reflect the consideration. So now, how are you going to do this? What are the conditions necessary to recognize it as revenue? Step one, identify the contract with the customer. So there should be a contract, a written contract signed with the customer. Second, identify distinct performance obligation, which means what is the obligation of the buyer and the seller. The buyer's obligation is to make the payment. The seller's obligation is to deliver the product or the service. So identify what are the performance obligations for each of the parties involved in the transaction. And then determine the transaction price. There should be a monetary value for the transaction. Allocate transaction price to performance obligation and recognize revenue as obligations are satisfied. So take an example. Let's say I get an order to supply 10 computers and also their annual maintenance. Right? So I'm going to say 10 computers. I'm going to supply for, let's say, $1,000 into 10. Plus annual maintenance contract will be $200 into 10. So this is the contract. So now we sign a contract. My obligation is to supply 10 computers and also do annual maintenance for it. Transaction price is also identified and allocate the transaction price to obligations. So I have two obligations, one to computer, one annual maintenance, and this is allocation. Separate. As soon as I deliver computers, this is revenue. But annual maintenance contract is deferred. Only once I provide maintenance throughout the year, this $2,000 will become my revenue. Otherwise, it will be considered as a liability until and unless the services have been provided. So a contract only exists if payment is probable, right? Once you can identify the transaction price and the payment is also probable, that is the only place where we are going to say, okay, there is a contract which is available. So under both IFRS and US GAAP, these conditions should be met for you to recognize revenue from an accounting perspective. Now, in this case, there is a principal versus agent example. Mega Digital is an online marketplace that sells goods and delivers them quickly to customers. For some sales, Mega Digital acts as a principal in which it controls the product before the goods are transferred to the customer. In other sales, Mega Digital acts as an agent in which it arranges for the transfer of a product controlled by a third-party seller. Assume Mega Digital sells a particular product for $100 that costs $70. Additionally, there are $10 of other selling, general, and administrative cost. So compute the income statement impact for a principal sale and an agency sale with a commission of $30, right? So we have to just create two income statements and compare that if this guy is acting as a principal versus acting as an agent, how will the profit and loss or the income statement look like? So let's quickly look at this. As a principal, $100 of sales, $70 of cost, $30 of profit, and $10 of operating expense, sales, general, and administrative expense, which means you are getting net profit of 20. And we are going to subtract these two elements to estimate what a principal will look like. Principal is straightforward. Now, in an agent, please remember, in an agent, you are only getting commissions, right? In an agent, we have said if it's an agency sale, you will get a commission of $30. So in an agency sale, we typically say you're going to get a commission of $30 You don't have to manufacture or sell anything. There's no cost of sales. You're not the manufacturer. You're just acting as an agent. You take the product and you sell it. So gross profit is 30, but to sell, you have to spend $10. And therefore your net profit is 20. Right. So this is how the income statement is behaving now. If you are the person who's manufacturing and selling it, you have cost of goods sold. But if you are just an agent responsible to sell, then you just get your commission on selling. You don't have to do anything else. And any small amount of money that you have spent on selling the product. And this is how the profit and loss statement will shape up between this for this problem. Take another one. Let's talk about situation where there's a franchise or licensing arrangement. Mount Pizza both operates and franchises pizza delivery restaurants around the world. Revenue recognition standards require that the company disaggregate revenue from contract with customers into categories that depict how the nature, amount, timing, and uncertainty of revenue and cash flows are affected by economic factors. So companies in this case must present revenues disaggregated into consolidated statements of income to satisfy the requirement. So what does the company do? The pizza company disaggregated revenue items into three different categories. How much revenue is coming from company owned stores? How much revenue is coming by franchisee royalties and fees and supply chain revenues? So now you're trying to present me segmental revenues. At times, these are also called as segmental revenues, right? How much is the revenue from different segment of the company? So these are segmental revenues that we are looking at here. Another situation, software as a service or license. Cream Software and Services is a technology company providing customer relationship management software and services to businesses, government, and not-for-profit organization. Therefore, organization may purchase a software license and install it on their own systems. Alternatively, they can subscribe to Cream's cloud service platform through which they can access Cream's software over the internet for a monthly subscription fees. Right? So business models. Now, this is how business models have actually evolved. There was a time when almost each software was based on a compact disk, right? You used to have a compact disk, and on that compact disk, we used to install the software in our systems. We were buying a product, and gradually the compact disk industry itself got eliminated. Nowadays, your laptops don't even carry a compact disk reader, right? So if you have an old compact disk with you, you don't have a reader where you can just, insert the compact disk and read what is there as the data. So the industry evolved and we moved from a product-based business to a service-based business. Now, if you want a Microsoft Office, you can buy an online license, install it, and use it. You don't have to worry about carrying a CD with you and installing it. You're not buying a product. You're more or less buying a software license and installing it on the system. Or if you don't want to buy a license, you can just pay monthly subscription fee and use if it allows you to use a monthly subscription fee. So business models have changed, and along with change in business models, obviously accounting gets impacted. Earlier, there was a product used to be sold, so there was a cost of goods sold. You were looking at product revenue. Now you're looking at service revenues because now you're only selling the service. There is no product as such. For long-term contracts, revenue recognition is different, right? Now, what are long-term contracts? Long-term contracts are contracts given in defense, infrastructure, mining, real estate as sectors. These contracts will these contracts will effectively, last for several years. So if it is a very long-term contract, how do you do accounting for it? What are the methods available to do accounting? Now, in this, like a long-term contract, the most commonly used method is percentage of completion method, right? We tend to look at how much of the work has been completed, and based on percentage of completion method, we recognize revenue, right? So take this as an example, and I'll solve this for you. Armored vehicle manufactures weapon systems and vehicles for military customers. The company enters long-term contracts that generally extend over several years. Performance on the contracts is satisfied over time. Now, this company has a contract to produce a weapon system for a total price of $10 million, right? So the revenue that we are looking at is $10 million. The expected total cost to produce is $7 million. So 10 cost is 7, which means the profit is 3. The system will take 2 years to produce. So how will you solve this? You will say 2 years to produce. In year 1, AVI will incur $4.2 million cost. So cost in year 1, 4.2, which means in year 2, you will do 7 minus 4.2, which is 2.8, right? Your cost is 2.8 because the total has to be 7. Okay, so your cost will be split into 2 years. You're not going to spend everything upfront, right? 4.2 plus 8, 5 and 2, 7, right? $7 million is the cost to, repair or cost to actually build this specific project. Now, with this, you will have to now recognize revenue. So the system is completed with an actual total cumulative cost of 7.5. Oh, they've changed the cost now. So they are saying the initial cost was 7, but by the time the system got completed, the cost changed to 7.5. So then we will have to change our number and we will have to say year 1, year 2 cost 4.2 and additional 3.3 because the total cost that eventually went up was 7.5 million. Okay. And the question says calculate the revenue and profit for each year. So we are going to use a method called we are going to use a method called percentage of completion method. This is for revenue recognition, percentage of completion method. This is used for long-term contracts. This is used specifically for long-term contracts. Now, what does percentage of completion method say? Percentage of completion method says identify how much percentage cost spent, percentage cost. So you will say 4.2 upon 7.5 and 3.3 upon 7.5. This is the cost which has been incurred. And whatever is the cost, year 1 revenue and year 2 revenue will be equal to 4.2 upon 7.5 into $10 million. That is year 1 revenue. And year 2 revenue, if we have to do it on a year by year basis, year 2 revenue will effectively mean 3.3 upon 7.5 into 10. So you will have two different revenue numbers. Total will be obviously $10 million, right? And let's just quickly do this. I'll just pull out my calculator. So first year, the revenue will be 4.2 divided by 7.5 into 10. We are looking at $5.6 million of revenue. Perfect.
Yes.
Just check 4.2 divided by 7.5. I hope I have not done a mistake. Into
Yeah.
10, 5.6. And the second year, the revenue will be the remaining number, which is 4.4. Perfect. So this is now your revenues. What you have done, rather than recognizing all the revenue in year one, you have pro rata revenue recognition. How much is the work completed? You have completed X percentage. And that percentage revenue can be recognized, and the remaining revenue goes to the next year. So we know the cost is 4.2, the revenue is 5.6, the profit therefore is 1.8 year one, and the profit for year two will be 4.4 minus 3.3. So the profit for year two will be 4.4 minus 3.3, 1.1, right? So that is 2.9. So that gets adjusted for our 4.4 minus 3.3 as your cost and revenue. So percentage of completion typically says split your cost. And remember, please, that is not the only revenue recognition method. There are methods such as cost recovery. There are additional methods such as installment sales. Earlier, these were all part of level one. I think some of them have been now shuffled or dropped. But again, within long-term contract also, there are multiple conditions. So your method can change. And all the scenarios that we are talking about are specific scenarios. Like in this scenario, there is a bill and hold arrangement, right? The AVI produces custom armored vehicles that some customers may not be able to take possession of immediately. And therefore, IFRS 15 provides that in such a bill and hold arrangement, AVI can determine when it has satisfied its performance obligation based on whether when a customer obtains control of the product. So if it's a bill and hold transaction, what is the criteria for revenue recognition? The customer must request for the arrangement. Product must be clearly identified as belonging to the customer. Product must be ready for delivery, and the supplier cannot use the product or direct it to another customer. If that is the case, you can recognize it as a revenue. Now, from a level one perspective, obviously this is all accounting, right? We already said that the program is not an accountant program. But the program basically says you should be able to understand how a company recognizes revenue, what is the model or the arrangement they are working with. Like look at Microsoft, right? So if you look at Microsoft's revenue recognition techniques, Microsoft will offer us, sorry, Microsoft will give us a revenue recognition section, right? So revenue, yeah, there you go. You have a revenue recognition section where they say our contracts with customer often include promises to transfer multiple products and services. Determining whether the products and services are considered distinct obligations that should account for separately versus together, we record it accordingly. When a cloud-based service includes both on-premise software license and cloud services, judgment is required to determine whether software license is considered distinct or not. So they are telling you how do we recognize revenue. And this is where I think these sections are important. You should be able to at least read and understand how revenue recognition is working for a business. Are they doing aggressive revenue recognition, or is it a conservative revenue recognition from an analyst standpoint? So that is the key objective of having these sections available for us. Now, under the Converge standards, what are the required disclosures necessary? So you will have to disclose information on nature of contract, amounts, and timing of cash flows from customers. Contract with customers disaggregated into categories, and contract related assets and liabilities. So when we say these are the disclosures required, these disclosures will go as part of your footnotes or notes to accounts. They will be generally provided as part of notes to accounts, and you may get a lot of this information there in terms of what is the obligation left from a company perspective. Like there is revenue recognition, there is also a concept of expense recognition. right? And there are a lot of debates around expense recognition because companies may want to report lower expenses to show higher profit, and some companies may want to report higher expenses to show lower profits. Both of them are objectives of the management. If the management wants to, showcase a lower value of the company, and why would they do so? Why would a management like to showcase a lower value of the company? They will show higher expenses, but what is the purpose? Why would you like to show a lower value of the business? Why do you think?
So can you repeat your question?
Why would a company like to showcase lower profits and show higher expenses?
For tax purposes?
To save some taxes, and also at times the management wants to report a lower profit because a lower profitability will translate to a lower valuation for the business. And a lower valuation allows the management to issue employee stock options to themselves at a very, very low rate, very, very cheap prices. So the vested interest is on both sides. Sometimes management wants higher profits to be shown, and sometimes they want lower profits to be shown. So expense and their recognition can be a tool to do this. Sometimes you are aggressive on expense recognition, sometimes you are conservative on expense recognition. And this is exactly where we have to be careful. Are the expenses being recorded accurately? Now, expenses can be classified by nature or by function, which means, simple example, a salary. Now, salary is an expense, and that is by nature of the expense, it's a salary expense. But then you can also record salary like this: manufacturing department salary, sales department salary, distribution department salary, right? And obviously admin department salary. So you can also put salary under each of these buckets, right? You can say each department has its own salary number separately reported. So you can do this. Some companies will do it like this by function, and some of them will do it by nature of the expense. All salary together, right? All four together, or all four under each of these heads. That is up to the management to decide what is a better representation of the data. So when we say income statement, it represents an economic benefit by way of inflows or increase in assets or decrease in liabilities, right? So if you are doing good as a business, your net profit will be more. Your revenues are more than your expenses. And if revenues are more than your expenses, it increases assets or decreases liabilities. Other gains and losses are included, which might or might not result from ordinary business activities. For example, you have a foreign exchange related loss. Now, foreign exchange related loss is not your business related loss. That is a one-time loss that you have. You were trying to hedge something and hedging went wrong. So other gains, other losses is not something which we are too bothered about. We are bothered about core business. What is your core business doing? Right? Income from services, sales of goods, commission received, purchase, manufacturing, administration. These are our core business related income and expenses. We don't worry about a lot of other income and loss on sale of investments or gain on sale of investment. These are other income and other expenses, right? So our focus is generally more on core revenue and core expenses, which means operating revenue and operating related expenses as well. That is something that we would like to look into. Now, in expense recognition comes a principle of matching. Matching is more of an accounting concept, an accounting principle, where it says matching principle says match the cost with its revenue. Take a simple example. I did an advertisement campaign And on an advertisement campaign, let's say I've spent $5 million. Now I've already given the cash. $5 million is gone out of the business. So how do I record this? I believe this advertisement will give me 5 years of visibility for my product. Right? So I'm thinking for the next 5 years, if someone is buying my product, they might have seen the advertisement. And therefore, in year one, if I have $7 million of sales from this product for which we have done advertisement, then you can straight away knock, let's say, $500,000 as cost and show $6.5 million of profit. So the idea is you will expense it. You will straight away expense the money over the next 5 years, right? You are going to say $1 million, $1 million, $1 million, $1 million, $1 million. 6 million, 6 million, 6 million, 6 million, 6 million. Every year I was getting $7 million of revenue and I was matching the revenue with cost. So this is how your accounting will do. If you are going to obviously try and match the revenue with the cost, because the revenue was coming because of the cost you incurred. Now in this, there are two types of expenses to be considered: direct expense and period cost. This is also called as product cost and period cost, right? So sometimes direct expense is also called as product cost or product expense, and this is also called as indirect expense. Now, product cost or direct cost is the expense related to the final output, which means final product. While period cost is expense which cannot be related to the final output, not related at all to the final output. Indirect expense or product cost, we follow the matching principle, take expenses in that year which include the corresponding revenue. So just take the same expenses and the corresponding revenue and match them. In period cost, take expenses in that year for which these expenses belong, right? So irrespective of the output, this is done. This expense has been incurred, right? In direct expense, we can what is called as capitalize the expense. Okay, and when we say capitalize the expense, just put it on the balance sheet and gradually amortize the expense. In period cost or indirect cost, it is simple expense. They don't have to do the capitalization part as such, that is available for us to do. So we have to find what are indirect or period cost versus what are direct cost or product cost. And when we say capitalize, we are basically creating an asset on the balance sheet, and then we are gradually depreciating the asset. Take an example, the matching of inventory cost with revenue. Khan Distribution Limited, a hypothetical company, purchases inventory items for resale. At the beginning of 2021, Khan had no inventory on hand, and during 2021, KDL had the following transactions. So they sold 5,600 units of inventory during the year at $50 per unit and received cash. The company determines that these were 2,000 remaining units of inventory and specifically identifies the 1,900 were from the fourth quarter and 100 from the third quarter. So what they did, they wanted to supply 2,000. They took 1,900 from here and 100 from here. Right. So in a way, 2,000 units were supplied. 5,600 units delivered, which is 2,000, 3,500, and another 2000, 5500, and 5600. These are the units which are left, and these are the units which are supplied. Right. So in this case, we are trying to find what is the gross profit, total ending inventory value, and cost of goods sold. Now, simple. When we say gross profit, we will have to find obviously revenue. How much is the revenue for each of these entities? Right. So from a revenue perspective, we are saying that we are going to sell it for $50. So revenue is 5,600 into 56, or rather $50. $50. Right? Because during the year, $50 per unit. So 5,600 into 50 to $80,000. That is basically what your revenue is, to $80,000. From $80,000, we are not paying anything as, or rather we'll have to calculate what is called as cost of goods sold. How much is the cost of the products which you have sold? So the simple answer is you have sold 2,000 inventory at $40. Sorry, you have sold 2,000 inventory of $40, 1,500 inventory of $41, and another 2,100 inventory of 43. You can multiply and add to get to that number, right? So we can multiply and add and get to that number in terms of how much did we sell. So as I said, my revenue will be very clear, 5,600 into 50. My cost of goods sold will be equal to 2,000 into 40, that is 80,000. Perfect. And then 1,500 into 41. So 1,500 into 41, that is 61,000. 61,500 actually, 61,500. It's 1,500 into 41. And then the last is 2,100 units into 43. That is 90300. So this is my cost of goods sold. You will add all of them. And once I add all of them, 231,800 is my cost of goods sold. So the gross profit automatically is this minus the gross profit is 280, or rather, yes, 280 minus 231,800. 280 minus 231,800. 48,200. Your gross profit is 48,200. So that is your first answer. Gross profit is 48,200. Cost of goods sold is this 231,800. So we have answered cost of goods sold and gross profit. What is the remaining value of inventory? You have 100 units left here and you have 1,900 units left here. So 100 multiplied by 43 and 1,900 multiplied by 45. So 1,900 into 45 plus 100 into 43, 89,800 is the ending inventory value. Perfect. So those are your three answers that we are looking at. Ending inventory. And remember, in this case, the assumption that the question took was first in, first out inventory. This is a very big assumption. The assumption is you are going to sell the inventory first, which came first, right? So you started selling from here, top. If you go reverse, the numbers would be different, right? The reverse method is called as LIFO. Whichever came in the last, I want to sell that first. So we followed a FIFO inventory mechanism, a FIFO method of inventory accounting. First in, first out. Give it a look if you have any questions. They are calculating cost of goods sold using this equation. However, if you wish, you can straight away do that as we did based on the number of units which were sold.
So, in the previous slide, you drew this example. Could you explain that example again?
This one?
I think one more back. Yeah, this one, the advertisement campaign.
Expense recognition. Okay. Let me just find a cleaner space to write something for you. So, let me just find it here. Okay. So see, when we say advertisement campaign, I have spent $5 million and I have already paid cash for it, right? So the cash is gone. On my balance sheet, on the asset side of the balance sheet, the cash is lower by $5 million because that has been paid to the entity who did the advertisement. But because I think this is going to give me benefits for several years, it is not a 1 year benefit, benefits for several years, right? This advertisement campaign is going to build my brand and etc. And let's say several year benefits, 5 years. I'm assuming 5 years for a sake of simplicity. This $5 million is not classified as expense. So we don't treat it as an expense. We treat this as a capitalized asset. We call it a capitalized asset, and the process is called as capitalization. So whenever someone tells you that there's a capitalization process, what happens? You reduce cash by 5 and you create an asset called as capitalized asset and increase your balance sheet by $5 million. It is basically thinking about it. You're spending $5 million and buying something worth $5 million. So on the balance sheet, no change. One goes down 5, the other gets created by 5, and your balance sheet is taken care of. Now, every year when you get revenues, because you told I'm going to get multi-year revenues because of this advertisement. You got $10 million, you got $15 million, you got $8 million, another $20 million, and $5 million, different revenues. So when you are getting revenue, you will have to match the cost of revenue. What is the cost incurred to generate these revenues? So we are going to say this capitalized asset of $5 million will get amortized for 5 years equally. So when we say this is getting amortized for 5 years equally, I am saying every year $1 million will be the cost that will be amortized. And therefore my revenue or gross profit will be lower by $1 million because I've spent a lot of it last season. Right. So this is something that has been done. You have matched the revenue to the cost. If you don't do this, then it will look something like this. You're going to say revenue year one. You're going to say year one, $10 million, cost year one, $5 million, right? Profit 5. And then for year two, you're going to say $15 million of revenue, zero cost, which is not possible. You cannot generate revenue without incurring cost. So this is incorrect. You have to follow what is called as matching principle. And matching principle says match the cost with its revenue. Do not do a revenue recognition without any cost, which is practically impossible without incurring any cost. You have, generated revenue. We are not working on cash concept. We are working on accrual concept. So whenever there is an expense, you have two decisions to make. Do you want to expense it or do you want to capitalize it? The decision is, if you think multi-year benefits, capitalize. If you think 1 year benefit or less than 1 year benefit, expense. Like eating a burger at McDonald's is a less than 1 year benefit, it is an expense. But buying a car, it is multi-year benefit. So we don't spend the value of the car in the profit and loss. We create the car on the balance sheet as an asset and we depreciate the car every year by a certain ratio. So the difference is always capitalized versus expense.
So in this
Sense?
case,
Mhm.
if let's say if you deem the advertisement cost to be expense instead of capitalized, in under year one, it won't be one, it would be five, right?
Yes, this is what it is, right? Under year one, 5. This is the example of expensing. So I said revenue 10, cost 5, profit 5. And
Okay.
then
So
in
this,
and then in next year, if you notice, I've said in next year there is no cost. So then you will have a very sharp dip in profits, and then you will have a very high increase in profit because there's no cost. So your numbers will look very, with spikes. Please switch on the light. Right. So you will have a lot of things where we'll see spikes in the data.
okay, thanks, sir.
And that's exactly where our next slide was, capitalization versus expensing. What is the difference between the two? And I think we did the example before, but now let's look at the theory part of it. So that may help you, much more. Costs are capitalized as a balance sheet asset or expensed in the income statement. Choice is ours, right? Less than 1 year benefit, expense. More than 1 year benefit, capitalize. If you expense, it will impact income statement. If you capitalize, it will impact balance sheet. Capitalizing means spreading an asset's cost in the income statement over multiple periods, creating a balance sheet asset matching principle, right? So create an asset of 5, and then in each year, spread it by 1, 1, 1, 1, 1 in the P&L. While expensing means taking an asset's cost as an expense on the income statement in the current period, all 5 in the same year. So cost incurred, expense if benefit beyond one period are unlikely or highly uncertain, which means less than one period or 1 year benefits. Capitalize if benefits extend over multiple periods. And this is where the debate is. Accounting doesn't provide a list that this has to be capitalized, this has to be expensed. It has some management inputs also in it. So sometimes there is a debate, is the management, you know, taking advantage of this situation, is biased in classifying expenses or capitalizing expenses, right? So that is something which the management has to take into consideration. As an example, Turton Limited purchased equipment costing £900 at the start of the year. The data below shows Turton's financial statements before the purchase is accounted for. 2000 is the revenue, 800 is the expense every year, zero depreciation, So you have 1200 of EBT, earnings before tax. And if you apply 30% tax to them, your net income is 840, 840, 840. Now, in this case, what is happening? The equipment costing 900 at the start of the year, and you have this as the data. Now, let's look at it. How does this table shape up when we decide about capitalizing versus expensing? How the data would effectively look. Now, Turton was incorporated at the beginning of year one by issuing equity of 1500 in return for cash. So on your balance sheet, you had 1500 equity, cash 1500, but because you made a profit of 840, see, your profit was 840. So what happened after year one? You recorded 840 of profits, and that 840 increased your cash also, 1500 plus 840. So year zero, the balance sheet was 1500 cash, 1500 common stock. Then after 1 year ended, you added 840 rupees on both sides because 840 rupees was the profit for year one. So cash became 2340 and you have retained earnings. After year two, this retained earning is nothing but cumulative profits. Cumulative profits. So you have another 840 rupees of profit. In second year also you have 840 of profit. So 840 plus 840, 1680. And your cash also increases by another 840, another 840, another 840. So this is telling you that your operational cash flow is getting money for you, 840, 840, 840. And in financing, you got 1500 in the first year by issuing equity. When you sell shares, money is coming to you. That is financing cash flow. Now, demonstrate how the accounts change if the 900 is capitalized or expensed and compute both net profit and ROE under both assumptions. So first, let's say this is getting capitalized. If it gets capitalized on the balance sheet, you are going to create 900 pound of asset. And 900 pound will be depreciated using 3 years life. So every year the depreciation will be 300. Like we were doing 1111 every year, they are going to do 300, 300, 300. Because you are capitalizing, and because you are capitalizing, you are creating an asset, and that asset is getting depreciated every year by 300. So you are saying 2000 plus 8 minus 800 of expenses minus 800 of depreciation, 300 of depreciation, 900 EBT, tax, and net income. So net profit margin should be actually 630 upon 2000. This should be 2000. Okay, make that correction. 630 upon 2000. Net profit margin is net income upon revenue. So this is the same example. You take a 5 and you distribute it 1111 every year. In this case, they have 900. They're distributing in 3 years. 300, 300, 300. They are capitalized. In the other example, where we say we are going to expense this, and then I'll come to ROE also. In the other example, what they are saying, we are not going to capitalize, we are going to expense. So in this 800, we are simply going to add 900. We are going to expense it the same year. We are not going to wait for 3 years. Which means if I'm going to expense, my profit and loss will look like this. 1700 in year one, and then 000 depreciation. Suddenly, I will have a very low net profit margin in year one. But in year 2 and 3, my net profit margin shoots up. So this is the disadvantage of, expensing. Your profit suddenly dips and then you come back to normal profit. This is an artificially low number because you decided to expense. Because the profits are lower, the return on equity numbers will also be lower in the later case. In this case, the return on equity is very simple. ROE, return on equity, is profit after tax divided by average equity. So equity is these numbers. Okay. And profit after tax is obviously what you see on your income statement. There is a profit after tax number here, 840, 840, 840. For us, it will be 630, 630, 630 because we are doing depreciation also. So 630, 630, 630, 3 years, and average equity, which means every year's equity number. 2 years of numbers take an average. But if you will expense, obviously return on equity will be lower because your profit is lower in year one. But their year two, year three numbers will be higher because there is no additional expense in year two and year three. Look, year two and year three, they are 800. There's no additional expense. All the expenses in year one. So year one is going to be very low, and year two, year three will be commensurately higher for them in return on equity numbers. Clear? Questions still here? Anything? Before we talk about the table, because table is critical. But any questions on expensing and capitalizing? Okay. Now, what are we talking about in terms of tables, right? And what is the table going to effectively do for us? Now, in CFA level one, there are multiple tables like this, where they, just change the headers. Like in this case, it is capitalizing versus expensing, right? So we are doing a table which is comparing. It is comparing, ROE in first year, other years, income variability, asset and equity. You cannot memorize these tables. Let's be honest about it, because these tables will have higher, lower, lower, higher written. So there is no way to memorize. You cannot memorize these tables, right? Which means, and this is not the only table. There are, I think, easily 10, 20 such tables in CFA level one book. Because you cannot memorize these tables, the idea is you should be able to derive these relationships. You should be able to practically derive the relationship or logically, analytically think about the relationship and answer. So you should try picking anything random like net income, ROE, or cash flow from operation and just think about it. Will it be higher or lower? You'll have to establish linkages. Like, for example, net income first year. If you are capitalizing, the expense is lower. And because expense is lower, profit in the first year will be higher. In this case, you remember 1700 was the expense. Expense is higher and therefore profit will be lower. So you just have to, build these linkages, and then you can answer the questions without, memorizing the tables. And in any case, memorizing the table is extremely difficult. I don't know how many people will be able to memorize these tables. And this is not the only table, as I said. There are several other tables for different topics in level one. Now, if profits are higher, obviously return on equity is higher in first year. And if profit is lower, return on equity is lower. So this is the way you test yourself. Okay, did I understand balance sheet linkages to income statement? Was I able to, comprehend what is happening? income variability. We said if you're going to capitalize, your income variability will be lesser. But if you do not capitalize, first year you will suddenly see a dip, and then you are going to see a increase. The volatility or the variability is much higher if you expense. So that is something that you have to think again and again. There's no way otherwise to answer these questions. And you should expect a lot of such questions where they just give you the analytical situation and they will ask you whether it will be higher, lower, or you know what type of analytical answer will be there. There will be no numbers. You will have to do it purely based on your understanding of the business, understanding of the concept also. Now, like you can capitalize expenses, you can also capitalize interest, right? So interest expense on funds spent constructing a capital asset is capitalized as part of one of these assets value on the balance sheet or assets value in inventory. Once the asset is complete, any further interest incurred must be expensed. So what does it mean? It says you are building a road project, right? So you're building a road project for which you have estimated the cost and now you need the funding. So let's say the road project engineering, procurement and construction cost and the toll equipment cost is 150 and then there is admin cost of 25 rupees. So 175 rupees is the total cost of building the road, which includes engineering, procurement and construction cost, equipment cost, and admin cost. So for 175, now you are going to raise money. So you're going to say equity. I'm going to put from my pocket 100. And the remaining I'm going to borrow, debt of 75. Now, as soon as you borrow the loan, your project is not going to give you money because you're building a road. It will take 2, 3 years to finish the road. So what are you going to do on this debt? If there is interest at 10% per annum, that interest gets added to the cost. You will create one more line here and you will say interest of 75 into 10%, 7.5. Interest is getting added to the cost because you're not able to pay it right now. You don't have the ability to pay. So it just gets accumulated on the balance sheet. You just add it to the balance sheet and say, okay, 7.5 dollars is added to the cost of the project. So now your cost goes up by 7.5. This becomes 182.5. So this also becomes 182.5. And if you're going to only spend 100, your debt becomes 82.5, which then multiplied by 10% changes your interest. Your interest becomes 8.25. And then this also goes higher. This is capitalizing interest. You are stuck in an infinite loop. You will keep running this loop because your interest will keep changing every time your numbers change. So if you have capitalized interest, you can add it to the balance sheet value. And once it is capitalized, you can start, doing spreading it over the years, like one or two, every year amortization of the interest will be there. So it is typically seen into project finance related mathematics because there we have projects which may not have any money from the start of the project. Companies generally have cash, so companies can pay it, regular companies can pay it, but infrastructure companies may not be able to pay these interests upfront. So it is capitalized on the balance sheet and then gradually getting amortized. Did we understand this infinite loop that we are going to stuck, or do you want me to model this on an Excel sheet quickly for you? Because you will be stuck every time you add interest. Interest is going to change the cost. Cost is going to change this. This is going to change the debt. Debt is again going to change the interest. And you are stuck in an infinite loop in this. You will have to keep running the Excel for at least 100, 200 times to get an exact number. Okay. So example, I think is very similar. They are just adding the interest on the balance sheet, and for us to be very clear, we are stuck in an infinite loop. You can actually look at this. That is the Excel one. Here is the Excel, right? So you can simply look at this. I will say EPC, engineering, procurement, construction cost, 500. Toll cost, toll equipments, another 200, and admin cost, 100, which means we need a total cost of 800 to create this project. So now if you have a total cost of 800, you are going to arrange the funding. So total funds that you require, total funds required is also 800. And you are going to say, I am going to put equity of 500, but the remaining amount I am going to borrow, which is 800 minus 500. So you're going to say, I'm going to borrow 300 at 10% per annum interest, right? So that is your interest. Now, because you cannot pay interest, you're going to add interest to the cost, and you're going to say, oh, I can't pay interest. 300 into 10%, add me. And now you see you're stuck in a circle. This is telling you it's a classical circular loop. This number changes this number. This number will change debt. Debt is going to change interest. And interest is again going to change the total cost. So you are stuck in an infinite circle denoted by the arrows. If I activate my Excel for this infinite loop, you will notice the Excel runs 100 times and gets you a very good estimate on 100 iterations. It keeps telling me that, okay, you can keep moving this, but every time these numbers move, these numbers are going to change the math for you. 33 goes here, 833, 833 goes here, 333, 333 again adds interest of 33. So this iteration ran 100 times to get you these numbers. If you need more accuracy, you can increase the number of iterations. So this is called as capitalization of interest. Now, there are certain differences in the way some of the intangible assets are recorded on the balance sheet, right? And this is purely a difference between IFRS and US GAAP, which means if you have internally created intangible assets, right? Internally developed intangible expenses such as expenses as incurred except R&D and software development. So research cost involve discovery of new knowledge and understanding, while development cost involve translation of research findings into a plan. What IFRS and US GAAP do? IFRS research costs are expensed, but development costs are capitalized. While in US GAAP, both research and development costs are expensed. You do not capitalize any type of cost in US GAAP. So IFRS says, okay, research you can expense, but development needs to be capitalized. Very important rule, and you should remember this, right? You should remember it by memory, by writing, whatever way you want, but you should remember this. because this is critical, right? In exam, they straight away ask such questions. And I think this is effectively what we should remember over a period of time. Software development. Exception for US GAAP is software created internally. Software, if created for sale, expense cost as incurred until technical feasibility is established and then capitalized development cost. So initial cost should be expensed, but development cost should be capitalized if technical feasibility is established. And software created for internal use, expense cost as incurred until probable that project will be completed and used as intended, and then capitalize the development cost. So expense initial cost for internal use software and then only capitalize the development cost. So this is for US GAAP software which is created internally. Now that could be for sale or that could be for internal use. Now in expense recognition, again, there are certain issues to be taken care of. What are these issues that we are talking about from an expense recognition perspective? Doubtful accounts. If the firm sells goods on credit, firm may not be able to collect entire money as customers would default. And therefore, firms need to estimate bad debt expense under matching principle, right? So if you have accounts receivable, you have to collect $500,000 from customers. But then you believe that, some customers will not pay. So you will do a bad debt expense and you will say bad debt expense of $100,000, which I think is not going to come back. And account receivable net is only $400,000. So this bad debt expense that you create, firm should recognize the expense in the period of sale rather than a later period when it actually incurs. So if you have sold the product this year, and if you believe the money is not going to come back, record the $100,000 expense in your profit and loss the same year. Be conservative in accounting. Don't be aggressive. Don't wait for it to happen. Say my loss has already happened, record it upfront. Similarly, warranty related to electronic products, goods. Recognize the expense again in the period of sale rather than a later period when it actually incurs, right? So if you have a 1 year warranty, 3 year warranty period, first year only recognize the expense and say, okay, 5% chance that I have to pay. After 3 years, if it doesn't come, you can reverse. Depreciation and amortization, charge it in the ratio of benefit received to the asset, right? So it's basically based on the life of the asset. Like you take a 3 year life, so 33% every year. If you take a 5 year life, 20% every year. Like we were doing for $5 million asset, we were doing 20% every year or $1 million every year. So it is dependent on the life of the asset, right? Or how much are you going to use the asset. Perfect. We will make a logical pause here because the next topic will take time and I don't think we'll be able to complete all of these slides in the stipulated time period. Next time when we begin, we'll start with non-recurring items, but I would take any questions that you may have on what we discussed today. And please understand the important topic, right? So go back and I think read income statement. If you don't want to read the introductory part of FSA, I'm okay. You can skip it. But if you want to start financial statement this week, I would recommend read income statement related reading. I think that is lengthy. That is very important. Balance sheet and cash flow are very short, but income statement has a lot of concepts to be talked about. So if you have time and if you can devote some of it, I think please start reading income statement. That is the only advice or recommendation today. Questions? Happy to take any questions that you may have on the topics that we discussed today around revenue recognition and expense recognition. These things have to be memorized. There is no other way, right? Just try and write it somewhere and memorize what is developed, what is capitalized, what is expense, and just go out in the exam and mark and come back.
So, there was an example that you went through for capitalized versus expensing.
Yeah.
I think there was like a table.
Yes. Here is the
Yeah,
table.
correct. Is it okay if you could quickly go through this example again?
I can once again, definitely. So let me just clear out the slide. Okay. So see, it all starts from this table. Okay, this. Right. So now first is capitalization. If we say capitalization, we are creating an asset on the balance sheet worth 900 pounds, which will be depreciated or amortized. You can call whatever you want for 3 years, which means 900 pounds will be divided by 3 and 300 pounds will be recognized in as a depreciation in my profit and loss every year. So rather than doing all the 900 here, right? If I have to do expensing, I will do it like this: 800 plus 900 and 0. If I have to do expensing, this will be 2,800 0. So I've created it parallelly for you. 2,800 0. So this is expensing. And now I think the comparison will be easy. If you have to capitalize it, 300, 300, 300 gets subtracted. But if you have to expense it, all of it gets in first year itself, 1,700. And therefore your profit is only 300 here, out of which if you take 30% tax, which is 90 out of it, you're left with 210 of profit. Right? So see on this slide, you're left with only 210 of profit because you have spent 1,700 here, but no depreciation. In the other case, you had 630 versus 210, capitalized versus expense. In this case, 630, but if you expense, this is 1,200, 400 taxes, or rather 360 goes as tax, you're left with 840. And same goes here, 840, 360, 1,200. And the both tables are now parallel for comparison. In this, you have very, very smooth profit reporting, 630, 630, 630. If you capitalize, no fluctuations. But if you expense, suddenly 210 and then suddenly 840. You see the variation in your reporting. So this is your expensing graph and this is your capitalization graph. So these are the two tables which we study.
So in expensing, we don't do depreciation.
No, because you have spent everything this year only. There is no asset on the balance sheet. If you remember this, in expensing, you don't take anything as an asset. You will just put all the cost as an expense on the income statement. There is nothing in the balance sheet. Everything will be expensed then and there. I think that is the only difference in capitalizing. You have to create it on the balance sheet like this. In expensing, there is nothing on the balance sheet. All goes in the profit and loss day one, and you're done. Because there is nothing on the balance sheet, there is nothing here in depreciation.
Okay, sir.
Okay, perfect. We're good for the day then. If no more questions, we will pause here and